Good afternoon, ladies and gentlemen. Welcome back to this weekly market review, the 14th of April. Together with me here today, I have Gerald. How are you, Gerald?
Hi everyone. We have had a very busy week in the financial markets, a lot of volatility. One day we are reacting to more and higher tariff, and then the other day we are hearing that it's been paused. So it's been keeping us very busy trying to keep up in terms of what is happening.
Yes, in fact, I got some friends asking me, "Hey, Sunny, is this the bottom? Is this the bottom yet? Is this the worst of the trade war tariffs?" Honestly, my answer to them is today the tariffs may be 50%, next day 100%. We are close to 150% now, so we don't know how this tariff percentage will move, and we don't know whether the 90 days tariff will move into a 180-day or a 360-day tariff. So it's very difficult to call the bottom right now, but later on, I'll show you on the technical charts where are the key support and resistance level that we are looking at. And over the week, we saw a very bad Monday last week on Monday on the weekly market review. Then on Wednesday, we got the 90-day pause from Donald Trump, which saw some big rallies in US. NASDAQ was up 12% that single day. And we got the CPI data followed by some of the bank's earnings on Friday. And Donald Trump said that he's open to a deal with China. And over the weekend, we also hear some of the exemption from electronics from the tariffs as well. So things are looking slightly positive. So I'll let Gerald take you through some of the developments that we saw last week.
Okay, before we start, the usual disclaimers that today's sharing is for informational purposes only. We have an upcoming SIAS on the 23rd of April, next Wednesday. So if you are a SIAS member, do join Sunny and myself as well as Benjamin, where you'll be able to ask us questions. If you find the weekly market review helpful, do leave us a review on Google. And if you are wondering how you can join SIAS as a member, you can go to this website, sias.org.sg/membership, or scan the QR code. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so like what Sunny mentioned earlier, we had a fairly volatile week in the past week. But overall, we still saw gains in the US market, with the S&P 500 up by 5.7%, the NASDAQ up by 7.3%, with the NASDAQ having a very significant gain on Wednesday of close to 12%. Okay, the STI caught up with losses in the US market in the previous week and closed 8.2% lower. So overall, we are seeing fairly sharp movements in various stock markets, and I'll break it down as to what are some of the drivers behind this. Okay, so in terms of the tariff news flow, Sunny has summarized some of the key developments earlier. So effectively, we saw some form of relief over the past week with the 90-day pause to the tariff for most of the countries except for China. And over the weekend, we saw further relief with the exemption to certain items as well. So I think that has been driving a lot of movements in the financial markets. But against this backdrop, we have also seen some of the economic data points coming up. We saw the inflation data actually easing in the month of March. So on a month-of-month basis, the core CPI was just at 0.1% in the month of March. This was actually below market expectations and provided some relief for investors who were concerned that maybe even before some of these tariffs were to come into effect, we might already be seeing fairly elevated levels of inflation. On a more negative side, the consumer sentiment weakened fairly significantly. This is the University of Michigan Consumer Sentiment Survey. And if you've been following our weekly market review, we have been highlighting that this has been coming down in the past few months. The latest data point for April weakened even further, and I had to go back to 2022 to be able to find a point where it was lower than where it was for the month of April. So with the uncertainty towards the tariff, the consumer sentiment has actually weakened, and we'll continue to see how this will impact the US economy in the coming months. On the other hand, this is also something that is worth highlighting is that the US government bond yields actually bounced in the past week. This might be a bit of an anomaly because typically when there are greater recession concerns, investors will go towards something that is very safe, which is US government bonds. So that would bring the bond yields lower. But what we saw in the past week is that the bond yields actually go up, which meant the price of the US government bonds is lower. And I think that has led to different kinds of speculation as to what is driving the selling in US government bonds. Okay, in the Singapore market, we saw the correction in the past week. So in terms of the top performers, actually, most of them still saw losses, just that the declines were not as steep compared to what we saw for the broader index. So the names that we see here are fairly defensive. We've got ST Engineering, Singtel, Frasers Centrepoint Trust, which are all typically seen as defensive names in the Singapore market. And SGX also emerging relatively better because of the view that the increased volatility in the market will drive more trading activity and hence benefiting SGX. Okay, in terms of the top losers, we've got Venture, which is a tech name, concerns around the impact from the tariff. We have got a number of banks as well having significant losses in the past week, and DBS down by 12% due to concerns about how the economic slowdown can potentially impact its earnings. Last but not least, being noteworthy here would be the performance of some of the logistics REITs. Mapletree Logistics Trust down by 18%, Frasers Logistics and Commercial Trust down by 12%. Effectively, they were impacted by quite a number of different things. First and foremost, concerns about demand for the logistics assets with the trade tariff. And then on top of that, the higher government bond yields, effectively taking out some of the flows from the REITs towards the government bonds. Okay, so I'll talk about some of the logistics REITs this week, given the volatility in the share prices that we see. So this is the share price of Mapletree Logistics Trust, down to $1.08 as of Friday. And I had to pull the chart back to about 5 years to see how much these REIT share price has actually come off by. And effectively, what we see here is that the share price is actually at a multi-year low. Okay, so for those of you who are not familiar with Mapletree Logistics Trust, it's got logistics assets across various parts of Asia. And we see here Singapore is about 20% of the assets, China is 18.5%, and then Hong Kong is about 23%. So like I think probably the concern is that with the trade tariff, how would that actually affect the demand for some of these logistics assets that it has? Okay, so overall, if you were to look at the distributions for Mapletree Logistics Trust, they have come off in the 9 months ending 31st December 2024. Overall, what we see here is that while the net property income has just come off slightly by about 1.5%, because of the increase in the borrowing cost, that's actually led to close to a 10% decline in the distribution per unit. Okay, if you were to look at the occupancy of the various assets, those have come down over the past few quarters, particularly in China, where it is fairly weak at about 93% occupancy. And I think more importantly, what investors might be concerned about would be the positive rental reversions that it has been able to get. That has effectively not been as strong compared to what we see earlier in 2023. Okay, so what we see here is that while the Singapore rental reversions are still positive, In China, we continue to see negative rental reversions. In the most recent quarter ending December, that was down by 10%. So that has actually dropped down the entire portfolio rental reversions. Okay, in terms of the balance sheet of Mapletree Logistics Trust, the leverage ratio is just slightly above 40%, having inched up in the past few quarters. Okay, if you are to look at the interest coverage ratio, 3.4 times as at 31st December 2024, still fairly decent level of interest coverage ratio compared to some of the other REITs. Okay, so at this point in time, the price to book ratio of Mapletree Logistics Trust at about 0.8 times, having come off fairly significantly over the past few months. It is now below the historical average price to book ratio of Mapletree Logistics Trust. Okay, and the expected dividend yield above 7%, which is more than one standard deviation above the historical average. Okay, next, Frasers Logistics and Commercial Trust. We have seen the share price of Frasers Logistics and Commercial Trust coming off over the past few weeks as well. Now also close to a multi-year low, like what we saw for Mapletree Logistics Trust. So, likewise, if you are to look at the exposure of Frasers Logistics and Commercial Trust, 70% of the assets are in logistics and industrial segment. So, likewise, the concerns about the trade tariff impacting the demand for these assets. Okay, if I were to look at the performance of Frasers Logistics and Commercial Trust, we actually saw that they were still able to grow its adjusted net property income slightly in FY 2024 by 2.7%. But what we saw was a fairly significant increase in its finance costs by about 40% in the latest fiscal year. And with that, the distribution per unit actually came down by 3.4% to 6.8 cents compared to 7.04 cents in the previous year. Okay, so if you are to look at the occupancy rate of the assets, actually the logistics and industrial assets are still enjoying fairly high occupancy rate. It is really in the commercial assets of Frasers Logistics and Commercial Trust that we have seen slightly lower occupancy rates. Okay, and if you were to look at the rental reversions of Frasers Logistics and Commercial Trust, once again, we see that it is their logistics and industrial assets that have done relatively better with double-digit positive rental reversions versus their commercial assets where we see slightly weaker reversions. Okay, so if I were to look at what Frasers Logistics and Commercial Trust is doing, they are trying to increase their exposure towards Singapore, and they actually announced the maiden acquisition of a logistics property in Singapore to be able to increase their exposure in this market. Okay, so at the same time, they are also more watchful about their balance sheet. So that would include looking at different ways to be able to not have the gearing go up by too much while trying to manage the cost of their borrowing. Okay, so if you were to look at the valuation of Frasers Logistics and Commercial Trust now, currently priced to book valuation of 0.7 times. So once again, that is below the historical average and close to the previous lows. And dividend yield of 6.7%, once again, above the historical average. Okay, last but not least, I just wanted to talk briefly about CapitaLand China Trust, another REIT where the share price has come off fairly sharply, again close to the multi-year lows. Okay, so unlike Mapletree Logistics Trust and Frasers Logistics and Commercial Trust, for CapitaLand China Trust, the business parks and logistics parks exposure would be a smaller part of its portfolio, representing about 29.3%, while the retail represents the bulk of its portfolio at 70.7%. But as the name of the REIT suggests, CapitaLand China Trust, so all of these assets are actually in China. Okay, so likewise, we have seen the share price of CapitaLand China Trust coming down as well. Current price to book ratio about 0.54 times, which is close to the previous lows. And in terms of the dividend yield, it is actually expected to offer a dividend yield of above 9%. Okay, so that's a summary of some of the REITs that were hit fairly significantly in the past week. Going into this week, we just saw MAS announcing its latest monetary policy statement this morning with some slight easing. At the same time, we have seen the MTI lowering the forecast of Singapore's GDP growth for 2025 to 0 to 2% from 1 to 3% previously. Okay, we have a number of the US banks reporting their earnings over the next few days. We have the Singapore one-year T-bill auction on Wednesday, and then we have some of the REITs in Singapore starting to report on Thursday, with Keppel DC REIT announcing on 17th of April. Okay, then we have a slight break going into the long weekend. So those are some of the key things that I'll be keeping a lookout for. And with that, I'll hand over to Sunny for the technical analysis.
Hey, thanks, Gerald, for that coverage on some of the latest developments in the markets and also some of the key REITs counter that you could be looking at. Indeed, when I was looking at the Gerald's presentation just now, some of the REITs are giving very attractive dividend yield, 9%. Even some of our blue chip Singapore names like the banks are also giving 5 to 6% dividend yield right now based on the prices that we see. So this could be a good time to be getting in on some of the big blue chip names because those names don't really come to such attractive level very often. So Singapore as a safe haven might be worth some more allocations into your portfolio. So let me look at some of the US indices first. So we have a very volatile but also a slightly positive week last week. So on Monday, we saw the very big drop on all the major US indices and of course Singapore as well. But then on Wednesday, we hear that Donald Trump is issuing a 90 days tariff pause, and that gave us some of the biggest historical gains that we have ever seen. So on the Dow Jones Index on Wednesday, we actually had a jump of about 7.8%, and then we ended the week up about 4.95%, close to 5%. So are we safe yet on the Dow Jones Index? I think the indication here is according to technical studies and readings, we are still below the 20-day moving average. We are still below the 200-day moving average. So we are not 100% safe yet. But have we bottomed out? According to the indication, looking at MACD indicator, we have seen the MACD line start to give some uptick, but it has not crossed over the signal line. That will give us the confirmation that there is a change in trend, moving upwards again. On the RSI, we have went into the oversold region last week as well. And then on Thursday and Friday, we had that very big jump and to bring the RSI back to the 44 points level. So on the indicator wise, it is telling us that the downtrend that we are seeing right now is actually subsiding. Are we going to go into an uptrend? We need a few confirmation, and that is where I'm going to share with you. We want the MACD to cross above the signal line. So a crossover indicate that there's a change in trend, and index will move upwards once the crossover happens. And the RSI, we want it to move above the 50-point neutral mark. That will further signal that the rebound momentum, the uptrend momentum is picking up, and hence the uptrend will more likely continue. Okay. And on even a longer term, we are looking at the red line here, the 200 days moving average. A lot of times investors ask me, are we safe now? Should we continue to go long? You can see that in the March period where we break the 200 days moving average level, we had a rebound and then we got pushed back down again. Okay, so we are looking at if you want a very firm confirmation that we are safe now, that is the 200 days moving average that we are looking at. If let's say the Dow Jones Index move above this level, which is 42,189 points, that is the level to say that probably the coast is really clear and we should expect the index to trend upwards again. So in the next few weeks, some of this indication might start to materialize. So first thing first, the crossover of the MACD indicator, the RSI moving above the 50-point neutral mark, and whether we could see a Dow Jones closing above the 200 days moving average of 42,189 points. Okay, next let me move to the broader index, the S&P 500, which saw a steeper drawdown. Okay, so this is where we are right now. Last Wednesday, when on the announcement of the 90-day pause, we saw a 9.5% jump on the S&P 500 index, and then we closed the week up about 7.8%, I believe. Okay, let me do the reading. We are up about 5.7% for the week on the S&P 500 index. Okay, so looking at how the chart is moving, okay, we are still quite a fair distance away from the 200 days moving average, now at 5,754 points. And also on the indicator wise, we do see some subsiding of the downtrend that we see, because the MACD line, the black line that you see here, is starting to tick upwards and looking for a crossover on the signal line that could give the confirmation of an uptrend. And the RSI, with a similar reading to the Dow Jones Index 44, is also looking to retest or even jump over the 50-point neutral mark. That will give us confidence that, hey, this rebound should have some legs and push up higher to retest the 200 days moving at 5,754 points. Unless we cleared this level, we are not totally safe, and that was the same observation that we see somewhere in the end of March, where we tested this level again and got pushed back down quite significantly. Okay, so all the indices are showing signs that the downtrend is subsiding, but we are not totally clear yet until at least we get back up above the 200 days moving average. That will give us more confidence that the uptrend will continue in the longer term, just like we have seen in the past few years. Lastly, let us move to the most volatile tech-heavy index, which is the NASDAQ. So NASDAQ saw a very big jump of a 12% jump on Wednesday after Trump announced the 90 days pause. And I believe this morning, after we hear that Donald Trump is going to pause the tariffs on electronics goods, you can see that the futures is showing a positive reading as well. So we believe this uptrend is likely going to continue for this week. And looking at indicators, we have also seen that MACD indicator is now very close to crossing the signal line. The MACD line is very close to cross over the signal line and above. That could give us the confirmation of a reversal in trend for a bounce back upwards. And of course, the key resistance level, 200 days moving average for the NASDAQ, is now at 18,400 points level. On the RSI, we have also went into oversold territory last week on Monday and Tuesday, and then we saw a rebound back to the 44 points level. So we are waiting for the confirmation to go above 50 with the crossover of the MACD indicator to show us a positive reading, and then we could actually execute a strategy to place a long position on the NASDAQ Composite Index to at least retest the 200 days moving average at 14,400, and from there we will see how well that momentum is driving the index up to plot our next move. Okay, so this is an overview of what the US indices are looking at right now with the tariff war in play. Next, let me move to the Singapore index. Okay, so Singapore index, we are up about 1.68% this morning on a Monday morning, 14 April. So you can see that the big drop has pushed us down. Last Monday, the big drop pushed us down the 200 days moving average as well. So the key level that we are looking at for the STI index is actually the 3,661 points level. We managed to test that on Thursday after we hear the 90 days pause announcement overnight. But then we got firmly rejected at that point as well. And some of the three local banks, the three Singapore, were some of the biggest losers last Friday as well, as we ended the week lower in the red. So last week, I think the three banks were down about 2.2% to 3%. DBS was the biggest loser, losing more than 3%. And it's seldom in the past few years that we saw DBS coming down below the $40 level. So this could be a good time. The dividend yield is also attractive at 5 to 6% for DBS share price right now. So it could be a great time to accumulate on some of these blue chip names in the Singapore index, okay? And of course, lock in those dividend yields as well at the current price that we are seeing. So the STI index, key level towards 3,660 points. We need to close above this for the longer uptrend to resume. On the longer term trend line that we are seeing, let's say if we connect the low that we saw in last year in 2024, somewhere in the July period, and of course in 2023, there are a few periods on the February, March, and the April period. You can see that if you connect this point, there's a very long-term uptrend identified by the black line right here. So if STI were to retrace back down to this level, now around I believe the around 3,400 points level, that could be a very strong support level for the STI index. On the indicator wise, you can see that MACD is still having a very strong negative reading, but at least in the past 3 trading sessions, that negative momentum is actually subsiding already, but it is not clear whether we will have a confirmation from the MACD indicator of a rebound coming back soon. So STI may be lagging a little bit behind the US indices. On the RSI, we also dropped deep down into the oversold territory. We've actually reached somewhere around the 13, 14 points level on the RSI, which is a very negative reading. But then after that, we snapped back up above the 30-point oversold mark. And now we are around the 36-point level on the RSI. So that means that the rebound that we see right now on the RSI indicator reading is still significantly weak. And we still have some way to go before we cross above the 50-point neutral mark on the RSI, which will help to indicate of a acceleration in the uptrend momentum. So on the STI index, we need to be a little bit more patient, and this could actually be a good level for us to accumulate further. So I think with the trade war going on now, and like what I said earlier, some of my friends asked me, is this the bottom yet? Are we seeing the worst of the worst already? So the situation is still very fluid. We still do not know how much the percentage of the tariff will change. Will Donald Trump reduce or add further? We also do not know whether the 90 days tariff will be extended or even there will be a resolution in the near term regarding the reciprocal tariff. So it's very difficult to call the bottom right now. But I believe the key thing that we have always advocated is to diversify and to dollar cost average. So this is a great time to continue to stay invested and dollar cost average your way, not necessarily doing a lump sum investment, but continue to dollar cost average your way, and then probably in sometime in the future, we will be able to sort of retest the all-time high on the STI index again, which is not too distant the memory, somewhere in the end of March at 4,005 points. Okay, so these are the updates that I have today. Any more things to add, Gerald?
Yes, so we have seen quite a bit of volatility in the market. I think the general view that I will share with most people is just to be staying calm. Do not act based on emotions, but think about how individual investments would fit into your overall financial plan. Like Sunny mentioned, now is a good time to revisit some of the positions that you have. And more importantly, think about how they will fit in towards how you want to be building your long-term investment portfolio.
Yes, that's exactly the words on my mind. So to all the viewers out there, stay invested, stay calm, don't be emotional. We will ride through this storm together, and we'll see you again next week in the next weekly market review. Goodbye.